passing on the mic to Dr. Rambabu.
Thank you. Thank you, Vikram. As Vikram introduced, I chair the Climate Change Committee at FICCI, and I also am associated with the GreenCo, a renewable energy company, and renewable chemicals and fuels company. As far as this session is concerned, we are focusing on investing into low carbon future, and as you all know, the markets played a very, very important role. Carbon markets played a very, very important role in accelerating investments into renewable energy in the Kyoto regime. When we had a Kyoto protocol in that regime, the carbon markets did play and catalyze and accelerate the investments into renewable energy. And subsequently, now today, under the Paris Climate Agreement, our ambition is very, very deep, and the urgency is also there. We need to get to net zero by 2050 at a global level, and limit the global warming to 1.5 degrees centigrade. That is the ambition. And this panel, I don't think we will explore what level of investments are required, how many trillions are required to get there, but whatever that we can accelerate and drive the investments towards the net zero future or low carbon future is the aim of this particular panel discussion. And while markets play a very, very important role, and the Article 6.2 and 6.4, which are hotly being debated, discussed, deliberated in this COP28, that will also be discussed to some extent. But beyond the carbon markets, there are varieties of investment instruments, may it be green bonds or climate bonds or many variety of debt and equity structures, that are being discussed. But over and above that, I am also hearing in this particular COP28 and even prior to that and beyond, is that it is the commodity markets, green commodity markets, that are also going to drive the investments into the low carbon future across the board. And while these investments into green commodities and disaggregated carbon investments, carbon credits and carbon price, we also have a significant investment that is required into the sectors other than industry, that is the agriculture and many other sectors. And besides, we also require a significant investment into adaptation. So, but here we are going to discuss more and more about the mitigation rather than the adaptation on this particular panel. With these brief remarks, I think I'll hand it over to you. Yes.
Yeah, thanks, Rambabu. Again, my name is Robert Tippmann, chairman of the German Emissions Trading Association. We've I'm co-moderate this together with Rambabu, and we have decided to have it two parts. I'll moderate the first part, which will focus more on internal carbon pricing mechanisms and the work that the Delta Foundation and also CDP have been working on, and a study related to that and questions related to that. And the second part by Rambabu, we'll talk more about Article 6 and the latest on that mechanism. But without further ado, then we would like to ask each of... we have two changes to the original agenda. So Bertrand Picard from the Solar Impulse Foundation is not going to make it due to a heavy interview schedule or other commitments, and we are still waiting for Daniel from the government of Ghana, hoping that he will join us later. So without further ado, then I would like to ask those who are around, the panelists, for an initial, and I think we can allow them a bit more time, 5 to 7 minutes, initial statement on the subject matter. And I think we can start here from here, maybe Shanshan from the Delta Foundation, if you want to go first, and then we go down there.
Okay, thank you, Robert, for the introduction. Good afternoon, everyone. Very happy to be here to present how Delta does, how internal carbon pricing has helped to drive the decarbonization within a corporation. For the technical problem, I hope it's not because of me, because my last COP presentation was 3 years ago in Poland, and the power went out just during my presentation. I had to take the opportunity to introduce the power storage system Delta provides that can definitely help better a resilient power infrastructure. And today we're coming to a very different topic, that's internal carbon pricing. Just last week, we read a report on Financial Times. It was written by the IMF Managing Director and the European Commission President and WTO Director General. The title was "No More Business as Usual." And the subtitle is "The Case for Carbon Pricing." And it says that there are 3 appeals for carbon pricing. They are, it works, it's cost effective, and the third, it's fair. And carbon pricing has gained traction around the world. According to the World Bank, there are 73 carbon pricing initiatives, and it's covered 23% of total greenhouse emissions around the world. And we see that the more and more people are seeing the importance of carbon pricing, and we're happy to report that Delta is one of them. I'd like to share with you our journey. The journey was back in the 1970s when the concept of sustainability is still in its infant stage. When Mr. Bruce Chen founded Delta in 1971, he thought that the growth of the company should not undermine the environment. Therefore, he set the company's mission as to provide innovative, clean, and energy-efficient solutions for a better tomorrow. And we're proud to be the world leader in energy efficiency. We provide services in 4 major markets, including power electronics, where we're the world's #1 switching power supply and provider, and telecom power. And we're also the tier 1 supplier for all major EV makers. And the third part is automation, where we focus on industrial and building automation. And lastly, we provide infrastructure, including data centers and energy infrastructures. When it comes to carbon management, we pursue quantifiable carbon reduction. First, we passed the Science-Based Target Initiative in year 2017. We're the first one in Taiwan to pass the 2-degree scenario. And we achieved that 4 years ahead of schedule in 2021. And in year 2021, we are committed to achieve 100% RE by year 2030. And in year 2000, I think it moved by itself. It did move by itself. In 2022, we are Taiwan's first and the world's 4th in the hardware equipment manufacturing industry to pass science-based targets under the 1.5-degree scenario. So, in addition to these carbon reduction efforts, we also think pricing carbon is very important. And we see there are several types of ICP, internal carbon pricing. There are implicit price, there are shadow price, offsets, internal fee, and internal trading. And we often see the most commonly used was the shadow price, where you have a price in mind to consider carbon during your investment considerations. And that's the mostly commonly used. And for Delta, actually we started in 2014 with shadow price. When we started in China, where our major manufacturing sites are based. And then we expand that to Taiwan and Thailand. And eventually in 2017, we have unified carbon price at $50 per ton. That's a global price. But at that stage, it's only a shadow price mechanism. But then we think it's not enough. We want to accelerate decarbonization. We want to deploy a new mechanism that is carbon fee mechanism. It's totally different. It's collecting carbon fee from our BGs. And we set the carbon price at $300. Every time I mention this amount, I see people raising their eyebrows because the global carbon fee is about $5 to $20, and even the European Commission suggested a way lower $85 carbon fee. But why Delta sets $300 as such a high price? It seems unbelievable. I would only say that it shows the commitment to align with IPCC AR6 1.5 degree scenario. So carbon is very expensive in Delta. And how does this ICP system go in Delta? We not only set the price, and we charge each BG the carbon fee as they, in accordance with the carbon emissions. And then we form a carbon fund. It's a global carbon fund. And we spend that carbon fund in two major areas. One is in energy saving projects. The other is in investing in R&Ds for low carbon technology and products that can foster circular economy. This chart looks very simple, right? But it is tremendous work. It takes meticulous management to manage all the details. And I'm very happy to say that we have a very strong ES team in Delta, and our Chief Sustainability Officer is here with me here. Jesse, would you like to say hi? So that you can have more communication with Jesse. And this is the system, and we'll see how this fund be used. 25% will be used on energy resource management. It's about reducing the existing emissions. Another 25% is about renewable development. It's not only just about generating more renewables for ourselves, but also investing other renewable projects. And the majority part, almost half of the carbon fund, will be in low carbon innovation investments. That's for new technology and new products that can foster a circular economy. And in order to be effective, we have to create a lot of new tools and new mechanisms, including the fee rules, the fund applications, the review standards, the project rules, and even the execution reports. A lot to be done. And we have to internally integrate a lot of systems, including finance and purchasing, so that it can work. We even set up 77 cost centers to govern the fund. And we have to deploy in our 8 major BGs in 157 sites around the world. And last but not least, education. We have to hold a lot of communication, seminars, training sessions for everyone to be on the same page. Let me give you a successful story, see how it goes. There is a Delta subsidiary that manufactures 20 components in the cell phone you're holding right now. And the first year, they are charged $24 million of carbon fee. You can imagine, of course, they're not happy. But then they found out they can apply for the carbon fund to invest. So in the following year, they invested $22 million in ICP projects, mostly in energy saving projects. And just within 1 year, their RE percentage has increased from 46% to 73%. And their greenhouse gas emission has decreased by nearly 17%. And in the following year, the carbon fee has dropped by 38%. They don't have to pay as much. So that's how it works. We hope it brings a positive circle for everyone. And lastly, I'll just show a chart to show Delta's revenue growth and our green gas emission. Greenhouse gas emissions. You will see a green line above. That's the line of Delta's revenue growth. It reaches $13 billion last year. And the purple line below was the greenhouse gas emission line. You see there is a significant drop in the year 2017. That's when we adopted Science-Based Target Initiative and have significant drop in carbon emissions. And we have more aggressive tools, including internal carbon pricing in 2021. So you will see the two lines go separately even more. We're very happy to present this chart because this proves what our founder thinks is right. Our business growth does not have to impact the environment, and we actually did it. We did it with all the efforts with every employee. And lastly, I'd just like to share with you that thanks to CDP, we're able to publish a report just a few months ago. In this report, when you download the QR code, you'll be able to see the ICP applications and practices so that more companies will be able to know how to practice ICP. And we hope that we all can use this tool to emission out. So this is what we have in the first stage to present. Thank you very much. Thank you.
Thank you, Shanshan, and for the presentation on the strategy by Delta Electronics. And then next, I would like to ask Pietro Bertazzi from the Carbon Disclosure Project. Please, Pietro, your first initial intervention.
Many thanks. It's a true pleasure being today with you, and what an amazing story you told us. It's really super positive, and thank you so much for the collaboration. It's fantastic to see our data being brought to life in this fantastic way. For those of you who don't know CDP, CDP is a global not-for-profit organization. We offer companies, cities, and regions the possibility to disclose on our platform their risks, opportunities, impacts, and dependencies on climate, water, forest, and now we're slowly expanding towards the broader concept of environments. At CDP, we've been growing disclosure and norming corporate behavior for the past 20 years. This year, we got 23,000 companies disclosing their environmental information on our platform. We do that on behalf of what we call the authorities. This year we had 746 leading international financial institutions across 40 countries holding over $136 trillion in assets. This is a bit, to the point that the moderator asked us, how we can accelerate action. Indeed, we are asking these companies to disclose because financial institutions want to have that information. So we act on behalf of the financial institutions. Financial institutions play such a pivotal role. It's not only this requesting disclosure, but then using those disclosure to ensure decision making, which is based on the fact, which is based on the data. We have a lot of great stories that we always like to highlight, including the stories about the Spanish bank BBVA that came up with a sustainability-linked loan with a European largest public electric utility, Iberdrola. The loan interest rate was actually tied to the company water footprint that was linked to the CDP water scores. That's a fantastic story to see how the disclosure that leads to a score that we assign to a company is actually used as a leverage for the interest rate in a loan. We have many other stories. I can tell you another one, which is about the Singapore Monetary Authority Green Finance Task Force that just completed the recommendation for a roadmap for scaling green finance in the real estate, in the infrastructure, fund management, and transition sectors. And the CDP data is at the core of that development as well. Of course, we work not only using the market leverage, but even trying to leverage the market to get the companies to do something. We intervene with policy engagements, and it's actually the work that I lead at CDP. We've been advocating for many years to get disclosure on a mandatory basis, so that every company has to disclose according to international standards, of course. And we offer our platform as a way to help to ease this. Of course, we've been experiencing a huge wave of mandatory disclosure across many jurisdictions. I will say mostly in the largest economies, but not necessarily. Actually, in Asia, there is a huge trend on requesting companies to disclose this information. We issued at the margins of the G20 this year, under the India presidency, a high-quality mandatory disclosure policy brief, where we highlighted 10 key principles. And of course, when developing those principles for high-quality mandatory disclosure, we think about how can we make sure that that disclosure is useful for the financial markets. And indeed, there are elements, innovative elements, including the transition plans that more and more investors are keen in understanding to ensure that all the targets that companies set are coupled with a strong plan. And that's why I love that graph, showing the delta about the growth of the revenues and the cut of emissions. That's exactly the story that we would like every company to be able to tell. When it comes to internal carbon pricing, of course, there is a question in our questionnaire about internal carbon pricing, and we have some insights that I would like to share with you. Since 2013, we've been reviewing companies' use of internal carbon pricing, and through years we've been accumulating data, and this data is actually shared publicly, including with the World Bank that has a yearly report on carbon pricing. In 2020, so 3 years ago, just over 5,900 companies were reporting carbon pricing data to CDP, with Asia showing actually the largest absolute increase since 2015. 3 years later, so in 2023, a total of 11,000, so from almost 6,000, it almost doubled to 11,000 companies reporting carbon pricing data, with the 15% of companies globally reporting yes to having internal carbon pricing, which was a 238% increase compared to the year before, and another 26% of those companies are planning to do so in the next 2 years. So this is just to say, it's a lot of percentages, I realize, but just to say that there is indeed huge momentum on the topic of carbon pricing. Looking through the data set over the years, CDP data shows that the most commonly cited reason for using internal carbon pricing is driving low carbon investment, which was a bit similar to the story of the 50% that you showed earlier. 63% of the companies establish as a reason to establish internal carbon pricing to drive energy efficiency and changing internal behavior, while others have actually planned to do so in the next few years. The highest growth in respect on this over the years has been in one specific sector, which is the one of the financial services industry, increasing 62% year on year on a quite steady basis. The other interesting part that we are particularly interested at CDP is the correlation between the establishment of an internal carbon pricing and climate action. Because indeed, we are here caught because we want companies to take action. That was the Paris Agreement spirit. All sections of society need to contribute to address climate change crisis. And there, I promise this is the last percentage that I'm giving you, there we realize that over 86% of companies that in 2020 received a A from our scoring at CDP are already have in place an internal carbon price or are planning to do so in the next 2 years, which really shows that actually internal carbon pricing is one of the elements that creates climate action. And therefore, we are super happy to continue this dialogue. I will cut it here for now. Thank you.
Thanks, Pietro, for the insights into the work, the very important work that the Carbon Disclosure Project is doing. So next, then we have Simon Henry from AITA. Simon, please, the floor is yours for the initial statement.
Thank you, and thank you very much to the organisers for the invitation to participate today. So I work for the International Emissions Trading Association. Our focus is on carbon markets around the world. Article 6 is obviously a focus for our work here at COP. I think in terms of looking at carbon markets and financing for climate action, I think carbon markets have a number of key benefits. I mean, just looking at the, what has occurred at the COP so far in the last couple of weeks, finance is obviously a huge focus of the work that goes on here. The first day we saw the launch of the Loss and Damage Fund to give the COP some momentum, try and build progress. And finance is always key to negotiations. It sort of greases the wheels of the talks, and it will always be a hot topic. But I think it's always going to be a challenging one because there will always be requests for more public finance to go towards climate action. But every government in the world faces significant financial pressure on how their public finance is deployed, and it will probably never meet the requirements of global climate action. So the question then is, well, how do you bring in the private sector? How do you deploy private finance to the climate crisis? And in some cases that can be difficult because it may not fit with the objectives of individual companies and what they want to achieve in their business. That's one of the benefits, I think, of carbon markets, because they can bring in a lot of carbon finance by placing either obligations on companies or voluntary commitments on companies. You can put a price on emissions, you can put a value on removals, and you can therefore incentivize companies to invest into climate action. That they are then either rewarded for taking carbon out of the atmosphere, or they are penalized by emitting carbon through having to pay a carbon price. So that starts to create a market that creates demand for these units, for these carbon products, carbon credits, carbon allowances, and that can drive finance into climate action. But carbon markets can also be a very efficient way of deploying that capital. The atmosphere doesn't differentiate between where carbon is emitted or where it's reduced, where it's removed. A ton of carbon emitted here in Dubai causes as much damage, as much global warming as a ton in the UK, in China, in New Zealand, wherever. So the damage is equivalent wherever you are, but the cost to reduce can vary hugely depending on your methods of abatement, your location, the energy price where you are, a whole bunch of circumstances. So if you start to put a price on carbon, you can start to then identify, okay, it's cheaper to reduce here, it's more expensive there, therefore I'm going to focus there where it's cheaper. And essentially you can get more, bang for your buck. You can deliver more with a limited amount of finance. And carbon markets are a very good way of identifying what we call those least cost abatement opportunities. So that's generally one of the benefits of markets, not just carbon markets. Any markets are usually very good at minimizing costs and being efficient in how money is deployed. So not only can carbon markets bring in private capital to this challenge, which is greatly needed, but they're also good ways of identifying efficient ways of spending that money and delivering as much emissions reductions as possible for a certain amount of money. And when it comes to Article 6, that's a topic that AITA, we focused a lot on recently. Together with the University of Maryland in the US, we've engaged in quite a comprehensive modeling project over the last few years. And the University of Maryland had developed this global climate abatement model, I suppose. So they look at the cost of the economy around, or economies around the world. They look at the cost of reducing emissions in economies around the world. And they've modeled essentially two scenarios. One scenario, if every country delivered on its NDC purely through domestic action, so just doing emissions reductions in their own country, and you come up with a cost for delivering that. And then another scenario where you have perfect cooperation between countries, so countries cooperating to reach their NDCs collaboratively. So in some cases, some countries might go beyond their NDC, other countries might fall short, but you would see a trade between the two, and you would see collective delivery of your NDCs. I mean, now that's essentially what Article 6 is, that international cooperation. And that study showed that by 2050, you could see a cost saving per year of about $250 billion through a theoretical perfect implementation of Article 6. So it shows the efficiencies. I mean, this is sort of a theoretical study, but it gives you a pretty good insight into Article 6 could save countries huge amounts of money in delivering their NDCs. And the studies have also looked at if you reinvested those cost savings into further abatement, you could achieve a significant increase in your ambition, potentially another 50% over what we have in the current NDCs. So a sort of 1.5 times Paris. So Article 6 is really, we think of it as really a really important tool to deliver greater ambition. And of course, that's exactly what we need. We need every country to step up with their ambition. We need everyone to go faster and further. So Article 6 is, one of the tools that can help us get there. And this problem only becomes more acute as we go deeper into emissions reductions. This study is only looking at the current set of NDCs that we know fall far short of the 1.5 degree goal or the 2 degree goal. If you start to see NDCs that are aligned to those higher ambition targets, the costs go up and the cost savings also go up. So Article 6 becomes even more important, more effective and more efficient. So I suppose in summary, we see carbon markets as being absolutely vital to bring in the private sector to the climate crisis. We see them being efficient tools to spend that money, but also a key enabler of more ambition under the Paris Agreement, which is absolutely essential. Thanks very much.
Thanks, Simon, sharing AITA's views on the carbon markets. And then we are glad that Daniel Lemte from the government of Ghana also arrived. And we would like to invite Daniel now to, from a government perspective, share his views on the subject matter discussed here today. Daniel, please.
Thank you very much. Yeah, it's okay. Yeah, thank you very much. I wanted to start from the perspectives from the Paris Agreement. I mean, when the Paris Agreement was adopted in 2015 and creatively established the NDCs then became the vehicle for communicating net zero commitments. And then since then, there's been a lot of government and corporations committing to net zero by the mid-century. So I think that is a very important byproduct of the Paris Agreement, creating momentum around net zero. I think I've seen many countries and cities and governments and companies committing to net zero. Now, that, in my view, creates a very interesting demand for action on climate, and also creating a very interesting demand for domestic carbon pricing instruments, because then that becomes a critical point where governments need to take concrete action to deal with their commitments. Now, from the point of view of Ghana, I mean, and many countries like us, our commitment was much more ambitious. We had to deal with a budget of around 200 million tons for the next 8-10 years. All right. But to be able to achieve that, we need to mobilize domestic and international resources, right? And the post-COVID economic situation affects many governments. There's high public debt. I did check this morning. I saw a very staggering number of around 100 trillion of public debt that are confronting developing countries. So on one hand, we are committed to take action on emission reductions, but at the same time, we are facing with high cost of living, high public debt, and also shrinking the fiscal space. So how do you mobilize resources within the limited fiscal space to deal with development investment and at the same time deal with the need for emission reduction? So that is what we are comfortable with. Okay. Now, on top of that is also the solution to deal with the shrinking fiscal space by implementing IMF conditionalities. All right, so you have to, the government is confronted with the fact that it cannot mobilize a lot of money to deal with its emission reduction commitments, and at the same time, it is focused on dealing with the conditionalities that would bring fiscal consolidation. So how do we deal with that? So one of the ways that we are dealing with this is to innovate with carbon finance. And I think the previous speakers already mentioned the importance of carbon pricing. So from the government's point of view, the carbon pricing instrument is a way to innovate around the shrinking fiscal space, to bring in private sector to innovate and create value of carbon to be able to deal with its commitment. But remember that at the same time, this instrument can help to also advance sustainable development, access to good energy, access to clean energy, access to good transport, access to efficient waste management. And at the same time, it is also able to help you reduce your emissions. So that is our approach. And in our view, we have carefully evaluated the options that are available to us. And in our view, the Article 6 market provides us with the chance of working with others to be able to achieve a higher ambition of our NDCs as compared to what we would have done by ourselves because of the fiscal space. So we have had a very ambitious Article 6 policy in the country by first creating a national policy on carbon credits and implementing a national institutional arrangement for carbon credits in Ghana to allow private sector to participate in both the domestic voluntary carbon marketing arrangement and also the Article 6 market. Now, on the side of the Article 6 market, we have a very ambitious program to create demand for carbon assets in Ghana. So we are working with the government of the Switzerland government, the Sweden government, the Singapore government, and recently the South Korean government. And the essence is to do what exactly he mentioned, that working with others is the best possible way of cost-effectively achieving our own ambitions and even increase the ambition of our own commitment. And that is what underpins our efforts, that to be able to achieve what we can do by ourselves and even achieve more, it makes sense to work with others. And that is what the Article 6 mechanism really seeks to do. That achieving more cost-effectively within the constraints, within the fiscal constraints that we are facing. Thank you.
Thanks, Daniel. And sorry, I just saw I got the wrong last name, but at least the first name I got right. Okay. So I think then we are done with the first initial statements and can start the first part of the discussion, where we want to focus a bit on what, in particular, what the Delta Foundation and CDP have been presenting on the internal carbon pricing mechanism, because and also the title of our event, now I thought about innovative, how innovative is that still? We do this for many, many years now. And then there are also the aspect of, okay, finance and financial ambition, but for me, what I would like to look at a bit is the impact of these approaches and financial mechanisms that you apply. And that's about scope, scale, and how deep you can go. And there's one aspect which I'm particularly interested in, which is also comes up here at the COP in many events, is the scope 1, 2, and in particular scope 3. That's a question I would like to put in particular to the others can come in as well, but Delta Foundation and CDP, to what extent the instruments and approaches that you in your study looked at, there are 4 or 5, from offsets till internal trading. How are they suited, or how well do they address the scope 3 emissions in the value chain, which, as we know, studies show that they can make up to 90% of the emissions of companies. So maybe, Shanshan, you can share your views, and then we can also hear what Pietro has to say.
That's an important question, but it's also a tough one.
I know.
Well, I can only share experience from Delta that we first applied shadow pricing, and it's just you have a price of carbon in mind without actually collecting carbon fee, and it started to change our mindset, and it helped us to do better management decisions. But when we switched and we started to launch this carbon fee mechanism, it's a totally different story, because all the BG heads know that they will be charged as how much they have this carbon emission. So the decarbonization has accelerated. But from the lesson we learned from Delta, I would say we are planning to expand to scope 3, but it's really a difficult and challenging task so far. And for scope 3, what we will plan to do is to identify and prioritize some special fields first, to look at the product life cycle, to track their carbon footprint, so that we have an idea and we can apply this carbon fee mechanism to our suppliers. Then it will bring pressure on them, not just for our inside BG heads, and I hope it's gonna accelerate as much as we did internally. And we're planning it right now, and we hope that it can bring in more from the supply chain to emission out.
That's interesting that mirrors or reflects a bit. I've actually worked myself on that topic in particular last year with the team, and what we've found out how it looks internationally. But maybe also Pietro, from CDP's perspective, how does it look like? I mean, you have a broad portfolio of companies, and please, maybe your views on the scope 1, 2, and then how you see the scope 3 tackled.
I promise I will have not shared any more, detailed percentages, but and I will try not to at this stage, even because I don't have them at hand right now. But of course, the big game changer is being able to attract scope 3. Nevertheless, we are still not on track for many companies around the world to get right scope 1 and scope 2. So I think it's indeed a challenge for many organizations to have a proper coverage of their different scope emissions. When it comes to scope 3, we realize that actually the percentage is incredibly low for there it is. the 42% of the companies disclosing with CDP in 2023. So those data, the fact sheet were launched literally a couple of days ago. Only 42% of the companies disclose at least one category scope 3. So it is still, incredibly low. While for scope 1, of course, it's over 60%, and scope 2 is around 60%. But even 60%, feels a lot, but there are almost 40% of companies that don't disclose scope 1. So the gap is still significant. Of course, the other, and I tend to see the positive side and the opportunities. The Greenhouse Gas Protocol is in the process of reviewing their categories. So I believe that could possibly give a further push for even a better understanding of scope 3, but still, you need to bear with us and, get more and more financial institutions to request that kind of data, to request that kind of disclosure, because that's a huge leverage that we can use as CDP to really nudge the companies to go in that direction. In the transformation we're currently going through as CDP, we're looking at integrating our questionnaire as well as looking a bit more thoroughly at those elements. And of course, the collaboration. Indeed, CDP was one of the founder of the Science-Based Targets Initiative, where the breakdown in the sectors and the planning really takes in consideration scope 3. And that's another element that we use to tackle to get more companies disclosing on scope 3. Of course, the sentiment of partnership is always there. CDP, we have limited capacity to deliver all of this, and we strongly believe that it is an ecosystem that needs to be conducive. Of course, and I'm sure others on the panel are much more proficient than me on this, but we are starting engaging as well with policymakers to understand how we can indeed move from voluntary carbon markets to more regulated carbon markets. The transition, I think, is inevitable. The pace, well, I feel that we feel the urgency, but the pace needs to take in consideration the current market as well. No policy will be effective if there is not already a substantial understanding in the market. So I think it's a fine dance, the one that we will need to play in the next couple of years.
Thanks, Pietro. I had actually another question, but I think you answered it already, Shanshan, about how you look at which of these mechanisms is best suited, but you seem to be at the beginning of the journey, I understand, and also a bit reflected to what Pietro is saying, where and even I don't want to ask how it looks with the SMEs. They have the SME hub where this is being dealt with. I've looked at actually now, if you've 900 signed up or something like that, but there are so many still out there, and well, it's really an issue, and that we'll need to look at, and I think it's urgent.
But maybe very, very quickly on this, it is indeed, I said at the beginning, 23,000 companies were still scrapping the surface, but actually the biggest growth they were experiencing is among small and medium enterprises. And of course, because there are many, we can cover them in many ways, but there is a huge understanding that from among small and medium enterprises that they position themselves in a competitive space, especially because many larger companies are being regulated. They will need to disclose this information. Look at the IFRS standards that cover scope 3. Look at the ESRS standards, which are the European Sustainability Reporting Standards, that indeed will be applicable not only for European companies, but there will be a spillover effect beyond Europe, as well as the upcoming directive on the due diligence. Supply chains will be involved, and there will be a huge trigger of disclosure among small and medium enterprises.
That was also a bit background of that the regulation is starting now in Europe, and that trickles down globally in the value chain and the supply chain, and you need to get ready, get your act together and start now. You're right. Yeah. I think with that, probably Rambabu, maybe if you wish, I can hand over to you, and then we have the second part, which deals more with the mechanism, Article 6 of the Paris Agreement, and where also the other panelists can come in and share their views.
Yeah.
So please, the floor is yours.
Thank you. This panel is on innovative finance, and I think the previous discussion was on how do you actually deploy the internal resources to right measures for the innovative finance. Way back, even during the beginning of this century, we had many guys internally in a company actually asking for bids for projects, and at what price can you reduce how much quantum of the emissions. So actually that led to a journey towards the marginal cost of abatement within an industry. And when we started looking into some of the Indian industries to look at what is the marginal cost of abatement, we have too many low-hanging fruits actually in India and many other developing country situations. Our marginal cost of abatement for a large part of the time, large quantum of the reduction, is actually much below $10. And as we go forward and go towards the net zero kind of a thing, the price starts increasing. So that is precisely what happens for any other company. So Simon, I was actually wanting to understand, when I look into the CDP data, for each and every company, it costs very high to abate the carbon. And even if I look into the market price signals all around, for example, EU ETS, the price is touching almost like $100. Let us, okay? And similarly, many other markets. But what is that is happening that the actual international carbon markets, the prices are hovering somewhere around tens of dollars kind of number. And the other thing that I wanted to combine your perspectives on that, the delay in Article 6.2 and 6.4 activity, negotiations, finalization and operationalization, is it significantly delaying the investments into low carbon future? Because we need to accelerate the action. So is it if you delay the whole Article 6 negotiations up to, let us say, 2025, 2026, then will it significantly impact the investments into low carbon activity?
Sure, thanks for the question. I'll take the second question first about the delay to Article 6 and how that's impacting investment, and it's definitely impacting investment, especially around Article 6.4. So Article 6 comprises various elements, a sort of a bilateral element where countries can cooperate bilaterally, and Ghana are leading there, and Daniel, I'm sure, can talk in more depth about that. But then also this 6.4, the central mechanism, often seen as the replacement for the clean development mechanism that we had under the Kyoto Protocol. And that's really where we're seeing the delays. And in some respects, that's not surprising, because we're talking about developing a global mechanism that every country has to agree on the rules. And this is quite technical. So it's been long and it's been hard, and there's still work to be done. But the slowness of that process is definitely delaying investment. IETA, in our membership, we have companies who develop these projects on the ground, and they would love to see this rule book finalized so that investors feel confident, projects can go ahead, units can be generated and transacted. So that is frustrating that this is taking a long time. But that's really the central mechanism. 6.2 gives countries a lot more flexibility to cooperate bilaterally without needing a central rulebook from the UN process. And essentially that was operational a while ago, and we are seeing countries move ahead, like Ghana, as I said. So, and there's a few really on the buy side and on the sell side that are really leading the way. I mean, on the buyer side, Switzerland, Singapore, Sweden, Japan, and a few others, South Korea. They are very busy. Their international sort of climate teams are very busy around the world and at COPs, places like this, signing agreements, signing MOUs to partner with countries to transact under 6.2. I've seen several announcements from Singapore, Sweden, and had quite a big announcement in partnership with the Asian Development Bank to set up a fund to buy some credits. The Global Green Growth Institute also announced a $500 million fund to buy Article 6 units just the other day. So 6.2, a lot is beginning to happen now, but it's quite a diplomatically intense process because it's bilateral agreements between countries. 6.4 will allow sort of a smoother process because it's a central mechanism, a central rule book. You don't have to negotiate a deal between every country every time you want to do a trade. So if this process can be sped up and we see, a finalized rule book that everyone can invest upon, that will definitely speed up action. I think the other question you asked about, the prices we see in places like Europe, where we have the European Union emissions trading system, a mandatory cap and trade system covering about half of Europe's emissions, versus the prices that we see for, especially in the voluntary market. Yeah, prices are very low, below $10 a ton, versus up to 100 euros in the EU ETS. It's partly a function of the way that the systems are designed. The cap and trade system in Europe is very different to the voluntary market. As the name suggests, it puts a hard cap on emissions. It places an obligation on installations across Europe, about 12,000 installations. They have to retire a sufficient, a number of allowances that is equivalent to their annual emissions. And the supply of units into that system is very tightly controlled by the regulator, the European Commission. The number of, the supply decreases every year in line with the targets, in line with the cap of the European Union. And it really represents ambition, I suppose. The reason that the price has been so high is that the number of allowances is declining very quickly in Europe. The scarcity of these units is going up all the time, and companies are still emitting, and therefore they're having to sort of, buy these units at increasingly high prices. And if you're generating power from gas or from coal, but having to incorporate a €100 carbon price into your decisions, that makes wind and solar look very good in comparison to your fossil fuel generation. And as a result, we're seeing massive deployment of renewables across Europe. The grid, the emissions intensity of the power grid in Europe is declining hugely. I think 22% emissions declined this year. I read from EMBA, I believe. Some of that's carbon pricing. Some of that's other factors as well. But where we have a high carbon price, a meaningful carbon price, where we have strong regulation and good ambition, we do see quite significant reductions in emissions. Carbon pricing is working very well. And in Europe, we're going to see a significant increase in the scope of carbon pricing. The European Union will be launching a second carbon market called ETS2 in 2027, 2028, which will cover the emissions from transport and buildings. So petrol, diesel, gas that is burnt in buildings to heat them. The proportion of emissions in Europe that will fall under a cap will significantly increase up to about 70%, and that cap will decline every year. So, yeah, we're really starting to see very stringent regulation on emissions across the European Union. I think just one other quick point on the ETS in Europe, which touches on the title of this session about innovative financing, is that the units that are used for compliance in the market, some are given away to companies for free, some are auctioned. So companies have to buy these units at auction. And auctions take place nearly every day in Europe. Several million are auctioned every day, and about 600 or 700 million auctioned across the year. And if you've got a price of €100 a ton, you get it becomes quite obvious that this raises huge amounts of money, and that money flows back to the member states. They have to spend that money on climate action. Some of it also goes into central funds within the European Union. That also goes towards research and development of low carbon technology. So you see this very efficient circular. I mean, it's a great example of the polluter pays principle, where money is flowing from high emitters through to low carbon solutions. And in some cases, it flows through to consumers to protect them from the impacts of carbon pricing, so helping to reduce their heating bills, for instance. And that, as this new market comes on board, as the price goes up, those mechanisms will raise increasing amounts of money for climate finance, climate action. So, yeah, not only are you putting a price on emissions where they're created, you're putting that obligation on the private sector, but you're also raising money for governments who can then deploy it into low carbon solutions.
Thanks, sir. Thanks. Thanks a lot for actually taking the question forward and covering the whole of the carbon pricing aspect in the ETS and the philosophy behind it, etc. Dr. Daniel, I think there is no question. I'm not going to ask about how Ghana has taken the leadership in Article 6.2 and signed variety of bilateral agreements with many leading countries like Switzerland, including South Korea, which is and even the Singapore, etc., etc. A few things that I want to ask you is that how is this carbon price and Article 6.2 and thereby the investments that are going to come into Ghana, how are they going to be directed towards the low carbon future? Is it that you are planning to only allocate Article 6.2 for a certain kind of measures within Ghana that will lead you beyond your NDC? And second thing I wanted to ask you is that you are amongst the host countries, you are the leader today. So what is the message that you want to give it to other host countries? Because Picky is the one of the organizers of this event, let us say to India, to other countries, as to how to take it forward and how to take the leadership forward on Article 6.2.
Thank you.
Okay.
Thank you very much. I wanted to pick on an earlier point about the seeming lack of progress on the negotiations on Article 6. I mean, we have a different view about the way the negotiations are going. In our view, the Article 6.4 negotiations would ultimately become a pathfinder for Article 6.2 for two reasons. One, in terms of the defining the structure or the requirement for demonstrating integrity. We think that when the Article 6.4 global architecture is designed very well, because that requires a lot of input from government, private sector, academia, and is done very well, it will become like a blueprint for Article 6.2, which is designed by 2 or more countries. And that is why we are pushing for it to be concluded, because then you don't want to create a differentiation of market mechanisms that appears to be soft on one side and strong on the other side. So structurally, we are pushing for the speedy conclusion of 6.4 so that it serves as a pathfinder for those who are interested in cooperating under 6.2. And it's very important because of this issue about integrity. And this afternoon, somebody made a very good point about the fact that Article 6 is about 3 things: benefits to the climate, benefit to the local people, or benefit to the host party, and the benefits to the buyer. All right. So how do we create a system globally that will allow this triple benefit to occur, and occur fast, and become impactful? And the reason why the Ghana government is much more interested or frontal in this is that when we did our abatement analysis about 5 years ago, it was based on a theoretical carbon budget of around 120 million tons by 2030, and over an average marginal cost of around between $11 and $15 per ton. And looking at what we can afford as a country, we could do the ones that are in the low-hanging fruit, up to $11 per ton. So what happens to the those that are above the $11 per ton. And for the ones that are around the $11 per ton, we could only do a quarter of it, a quarter of the entire budget. So what happens to the rest? So what we did was that if we really want to go or increase the ambition of what we want to do, then we need to cooperate with others. And the cooperation would achieve three things. Not only allowing us to increase the ambition of what we want to do, but do so cost effectively and also unlock finance to private sector to be able to participate in this. It means that not all the projects are we willing to authorize. So we have what is called a red list. The red list are the ones that, in our view, are low-hanging fruits, and they will happen anyways and are not financially additional. So those ones are not available for creating ATMOs for international transfer. So we have a very carefully crafted positive list and red list out of which we are willing to authorize. And they must all fall within the 120 million tons budget for the next 6-7 years and beyond.
And, thanks a lot. You are also authorizing unilateral projects for other purposes.
Yeah.
That is one thing that, do you think that that will pass through? Or our negotiations will put some lid on that?
There was an effort to put a lid on that, but it didn't see the light of day. I mean, and there was a proposal to change the structure of what a cooperative approach is, that it ought to be done by two participating parties who are parties to the Paris Agreement.
Yeah.
But that was not the original spirit of the Paris Agreement.
Absolutely.
So that proposal didn't see the light of day.
Okay.
So we think that unilateral approach is still on the table. It has a huge potential beyond NDC, beyond authorizing for NDCs. And therefore, in our view, that should be part and parcel of the cooperation beyond government.
Absolutely.
Yeah.
Thank you. Thanks a lot. I think we lost some time, but we are not being given the time back. So I think we have very little time for questions. Over.
Yeah, thanks, Ramabu. And we thought we allow also for questions from the audience you may have to those that presented here. So I think we have another. We started. No, we have a bit more time. I think it's not right because we started late, so we have a bit more time. If I'm not right. Please, if any questions. So I see over there. Yeah, if you can. Do we have microphones here, or how does it work for the audience, or is it?
Or can you?
Or just stand up, speak up, and maybe introduce yourself and whom the question you have, whom you would like to address.
So much. So nuclear is a decarbonized energy, and we're wondering if Europe will catch up with Canada, who is actually now having nuclear certification for clean energy. So is there a possibility that IET or other organizations would catch up to that and do what Canada is doing with their clean nuclear energy regarding certification and credits? Thank you.
Anybody wishes to pick up on that? Simon's grabbing
was addressed to Simon
mic.
Yeah.
Anita was mentioned. Yeah.
Yeah. It's a good question. I mean, we see build out of nuclear in parts of Europe. So France, Sweden, the UK are all building reactors, proving very hard and very expensive. In terms of their role in a carbon market, I don't see a role for them in a carbon market in those countries. I mean, we have in Sweden, France, the UK, you have a compliance emissions trading system where there is no use of offsets, no use of credits. It's all allowances. So it's it's digital certificates that are generated every year by the regulator. They don't relate to a project on the ground. They are purely an accounting tool, and the volume of them goes down every year. So nuclear power is still incentivized in these countries because it's zero carbon, So they don't have to pay a carbon price, unlike their gas-fired competitors or coal-fired competitors. So I guess in Europe we see a slightly different system where high carbon emitters are penalized, but low carbon emitters are not rewarded in that sense. It's a one-way mechanism that penalizes the emitters.
Yeah, I got that, but I was wondering if it was possible to use those credits generated by nuclear power to offset.
Well, in Europe, you couldn't generate credits in Europe from nuclear power. There's no mechanism for that.
Oh, I thought that people were working on this. I spoke already 3 years back, and people were saying that they were looking into this. So I wanted to make sure there was any progress.
Maybe outside of Europe, but not within Europe itself, I don't think. I don't see a mechanism for that.
Okay, thank you very much.
Yeah, when we start over here, you're first. Oh, the mic.
Hello, thank you. My name is William Etzler. I'm an undergraduate researcher at Virginia Tech. My question is generally, how are you guys dealing with sectoral leakage in your enforcement of carbon pricing? Thank you.
Maybe we can collect two more, the ladies on the left.
Thank you very much. My question is about the conversation that we're having about carbon markets. We are praising a lot carbon markets as an instrument here. And don't take me wrong, I like carbon markets, and I think it's a very interesting piece of the puzzle. But the history of renewable energy deployment, at least in Europe, in some other countries, is not a history of carbon pricing mechanisms. Carbon prices has been one of them, but it has started to work very recently. Only until 1 year ago, 2 years ago, we have seen prices able to actually hook investments and foster the private sector on that. It has been the history of other type of instruments, feed-in tariffs, auctions, that have created the market where it didn't exist, and then the carbon price mechanism enters into the game. My question then, I guess, is how you see the role of these other mechanisms in the whole deployment of renewable energy or climate solutions around the world, above all in the conditions that we are seeing mentioned by many bodies, like the IPCC, in which we will need other technologies that are not ready for the market, that we will need to boost. What's the role of carbon pricing and other mechanisms on those terms? Thank you very much.
Hi, this is Professor Li from Taiwan, and I have a question on the alignment, because now we have a variety of carbon trading markets. Then we have, the one in China, and then the European ETS, and some other voluntary markets. I'm wondering whether all these different credits can be either transferred or we don't. You just do your own thing, but we don't.
My name is John Lin. I'm CEO of Stop United Fund, but I'm also a CPA. So my question number one is that to Mrs. Guo, based on your ICP, do you see that your performance shows on the stock market price? Number one. And number two, to the governors, I saw your professor teaching accounting. So the question is how the accounting side reflection on this emission cost or environmental credit. Do you have any? Thank you.
Maybe I'll take the very specific one here. Well, for Delta, the carbon fee mechanism is now only in our internal management report. But when we spend that money from our carbon fund, it will affect our financial report. But you see there is still a positive cycle, I just show in the chart. And I think the very reason why we will dare to price at $300 per ton is because our CEO looked for longer term. For those low carbon technologies we invested in, we were looking forward to having them to return on Delta in the much longer term. As for the stock market price, we see it's rising for the past few years. I don't know if it's directly correlated though, but it's definitely gaining recognition from our investors. Thank you.
I may get a very quick reaction to what is there beyond carbon pricing. That's, making a bit more easy what you asked. And indeed, we've been discussing about that because it was the topic of the panel. At CDP, we intervene in the financial regulation with a number of different ways. I can tell you that we follow very much the agenda of the climate finance ministers for climate action, which is quite important and cuts across different areas. I was literally looking at the areas. They look at aligning different policies in the government with the Paris agreements. They're looking as well, indeed the carbon pricing measures, as well as mainstreaming climate in economic policies. So it's looking as well as the functioning of the central banks. And I can tell you that in that case, we engage a lot with the NGFS, looking indeed at different measures the central banks and financial market regulators can actually put in place to adjust the markets. Mobilizing climate finance and engaging in NDC development, those are the elements of the Coalition of Finance Ministers for Climate Action. And of course, the other way that we intervene is indeed, making more data available. So that's the way that we come in. But of course, there are a lot of other elements. I can think about CBAM, indeed in Europe. There are many different entry points. So there is no silver bullet point. So that was not the message of this panel. Today we delved into one specific element, but indeed, it's a mix of policy measures. We always call for a smart policy mix. Very superficial answer. We can talk more later if you wish.
I can address the questions over here. I'll try and be brief. But also touching on CBAM, so the question around leakage, the European Union will bring in a carbon border adjustment mechanism quite soon. The UK is also looking at a CBAM, and that will essentially put a price. Well, it will ensure that producers of certain industrial products who are exporting those products to Europe and who may not pay a carbon price in their country of origin, it will place a carbon price on those products at the border. So if you're a cement manufacturer in India and you don't pay much of a carbon price, or you pay no carbon price, you're going to have to pay the carbon price that the EU has on the products that go to the EU. So it's going to be very interesting to see how it works. It's been spoken about for many, many years. Hopefully it's very effective at leveling that playing field, reducing leakage, internalizing the cost of carbon in these producers. It sort of also touches on the other question about linkage of markets. This was a big focus for many years. It's been very difficult. We do see some market linkages. The EU and the Swiss market is linked. California and Quebec is linked. But as markets get more complicated and the market designs diverge, it gets harder in the future to link. CBAM is going to be interesting because it will levelize carbon costs on exports. The best way to avoid CBAM would be to link markets. You'll see price convergence and therefore no need for a CBAM if producers in both countries are paying the same carbon price. It's probably quite optimistic to think that these big markets like Europe and China would link, but at least we will see convergence when it comes to the exports because of CBAM. And it's possible that maybe China would implement a reverse CBAM on products going into Europe. Complicated, but possible. And then the other question about other mechanisms funding, renewables in Europe, and you're absolutely right, subsidies have been very effective in bringing forward renewables. I think subsidies and carbon pricing can work very well. Carbon pricing is the stick, renewables is the carrot, and collectively they can work at both ends of the scale to incentivize renewables. And in some cases we're now seeing, the removal or the reduction of subsidy regimes because renewables are pretty much cost competitive, especially in places where you've got a high carbon price, therefore that also brings them into the money. So, I think the mechanisms can work pretty well together.
You haven't.
Yeah, just briefly. CBAM could be, leakage measure 2.0, but there is also leakage measure 1.0, and we are considering the issue of the issue of policy crediting and sectoral crediting at the national level. To have a bigger band rather than dealing with projects. So that is probably one of the ways to also deal with leakages internally within a sector that we are trying to explore that. Accounting, I think the accounting at the level of project, at the level of the facility, at the national level, the sectoral level, are not matured across board. And that in itself is a big challenge for countries that are intending to participate in their markets. And we have the same problem in Ghana. We don't have enough matured accounting systems at the level of the facility. And that is our focus now. Yeah.
Okay, I think although we started late, so we were allowed to take a bit longer, but I think now the next event, they are waiting outside. So on behalf of the organizers, FICI, Delta, and VVAK, I would like to thank all the panelists for sharing their views on carbon markets, internal pricing mechanisms, and also thanks to the audience for interesting questions. And I wish everybody a nice evening. Thank you. Okay. Hi, nice to meet you. Sure.